Welcome. Today we are going to discuss about corporate social responsibility, that is CSR, and corporate sustainability. And this is the third module under corporate governance and secretarial practice. Let's start. Concept of CSR. According to the Commission of the European Communities 2003, CSR is the concept that an enterprise is accountable for its impact on all relevant stakeholders. It is the continuing commitment by business to believe fairly and responsibly and contribute to the economic development while improving the quality of life of the workforce and their families, as well as of the local community and the society at large. Therefore, the concept of CSR, whereby companies integrate social and environmental concerns in their business operations and in their interaction with their stakeholders on a voluntary basis. The main function of an enterprise is to create value through producing goods and services that society demands, thereby generating profit for its owners and shareholders, as well as welfare for society, particularly through an ongoing process of job creation. However, new social and market pressures are gradually leading to a change in the values and in the horizon of business activity. Let us now look at the meaning of CSR. If we look at the definition of CSR, we will see that CSR is the way firms integrate social, environmental, and economic concerns into their values, culture, decision-making, strategy, and operations in a transparent and accountable manner, thereby establishing better practices within the firm, creating wealth, and improving the society as a whole. CSR is also referred to as corporate citizenship or corporate responsibility. Fundamental landmark, Bowen, 1953. Howard R. Bowen, in Social Responsibilities of the Businessman, defined corporate social responsibility as the obligations of businessmen to pursue those policies, to make those decisions, or to follow those lines of action which are desirable in terms of the objectives and the values of our society. WBCSD, or the World Business Council for Sustainable Development, described CSR as the continuing commitment by business to behave ethically and contribute to economic development while improving the quality of life of the workforce and their families, as well as of the local community and society at large. Now let us look at the strategic importance of CSR. CSR serves as a critical business strategy. Consumers prefer trusted brands. Suppliers and employees value reliability and respect. NGOs or non-government organizations seek collaborators. CSR enhances stakeholder relations and market penetration. CSR activities impact all stakeholders and contribute to the firm's bottom line and long-term viability. Stated briefly, CSR is about taking stock of economic, social, environmental impacts of a business, mitigating the negative impacts and bolstering the benign impacts, and finally, taking up action programs and community investments to reduce social exclusion and inequality to address the key sustainable development challenges. Let us now look at the CSR policy. A company's CSR is a voluntary commitment to operate within its community through a formal CSR policy that outlines project selection, measurable goals with timeliness, governance responsibilities, and systems for monitoring need and impact assessment, and even independent evaluation. Companies often collaborate with local authorities, NGOs, and suppliers, encourage employee volunteering, and engage with recognized CSR platforms to improve strategy and reputation. They should then describe their policies, progress and activities transparently to stakeholders and the public via the websites, annual reports, and other communications to reinforce their image as socially responsible. An effective CSR policy may include the following: identification of thirst areas, identification of manner and nature of projects or activities defining measurable targets and time frame for the activities, performance management, quality and standards of the work to be maintained, organizational mechanism and assigning responsibilities for due performance of the CSR projects, manner of delivering CSR, that is, the foundation or partnership with non-government organization or participation of employees, budget allocation and its utilization, and medium of dissemination of information on CSR. CSR thrust areas companies may include in policy: Number 1, eradicating hunger, poverty, and malnutrition, promoting preventive health care, sanitation and safe drinking water, tree planting and building cyclone or hurricane-proof shelters for coastal communities, promoting education, spatial education and vocational training, focus on children, women, elderly, differently abled, livelihood projects, promoting gender equality, women's empowerment, establishing homes or hostels for women and orphans, old age homes and daycare for senior citizens, reducing inequality for socially and economically backward groups, ensuring environmental sustainability, that is, the ecological balance, protection of flora or fauna, agroforestry, conservation of natural resources, and improving soil, air, and air quality, protecting national heritage, arts, and culture, which includes restoration of historic buildings and works of art, setting up public libraries, and promoting handicrafts or traditional arts, supporting armed forces veterans, war widows, and dependents, promoting rural supports, nationally recognized and Olympic disciplines, contributing to the Prime Minister's Relief Fund or other government funds for socio-economic support of scheduled castes, scheduled tribes, OBCs, minorities, and women, funding government-approved technology incubators in academic institutions, implementing rural development projects, developing slum areas as officially designated by the government, installing biomass processing plants, as for example biogas, solar panels in natural homes, waste recycling units for urban poor communities, and effluent treatment plants or ETPs in manufacturing, and even installing productive on-farm or off-farm employment schemes, especially in high seasonal unemployment regions, for example, flood-prone northern districts in Bangladesh. Now let us discuss about corporate citizenship. It is actually a commitment to the society. So corporate citizenship is a company's voluntary commitment to enhance community well-being through business practices and resources investment that foster sustainable growth. Corporate responsibility is realized when CSR efforts are aligned with business objectives and meet or exceed society's ethical, legal, commercial, and public expectations. This mindset involves maximizing positive impacts and minimizing harm through adopting demand-led strategies rather than the supply-driven strategies, prioritizing the welfare of all stakeholders, engaging in participatory community collaboration, balancing economic costs with social benefits, emphasizing process-oriented action over rigid structures. The ultimate aim is to create a dynamic synergy among businesses, communities, and philanthropic activities. Key dimensions of responsible corporate citizenship include creating absolute social value, that is, ensuring long-term social benefits, ethical corporate behavior, avoiding short-term gains that erode trust, environmental safeguarding, valuing resources properly and planning for ecological costs, equitable business practices, fostering fair competition and transparency, CSR integrated into core business strategy, eco-efficiency innovation, that is developing sustainable human-centered processes, inclusive market creation, let's say designing offerings for all consumer segments, holistic stakeholder partnership, transforming dialogue into collaborations, and statutory compliance, adhering to laws and earning societal legitimacy. Now, the question obviously arises, why CSR? Why should it matter? While traditionally only governments handled social welfare via taxes, it's now widely accepted that businesses also have a vital role in societal development. CSR should be integrated into companies' purpose to create a positive synergy between its commercial goals and its social responsibilities. Top reasons businesses are expected to engage in CSR. Number one, public expectation. We all know that since the 1960s, society expects businesses to pursue social as well as economic goals. Then comes long-term profits. Now, stronger community relations and enhanced reputation obviously lead to more secure profits over time. Then comes ethical obligation. Responsible actions are right in themselves, regardless of profit. Then comes public image. Now, social engagement obviously builds customer trust, there's no doubt about it, and then attracts talent and supports access to financial market. Then better environment. Contributions to social solutions make communities more livable and attractive to skilled workers. Then comes fewer regulations. So you see, when you become proactive and proactively responsible, then it will automatically reduce the need for external governmental regulations. Then comes responsibility power balance. Corporations wield power and thus must uphold corresponding social responsibility. Shareholders' interest. CSR enhances long-term stock value by lowering perceived risk. Available resources. Corporations have the financial, technical, and managerial capability to support social causes. And finally, preventive actions. Addressing social issues early will obviously prevent escalating prices that harm productivity and business goals. Let us now look into the key stakeholders of CSR. Stakeholders are individuals or groups who can affect or are affected by an organization's objective. This concept, introduced by Freeman in 1984, highlights the importance of various parties in a company's success. Stakeholders are categorized into internal and external groups. Now, who are the internal stakeholders? Managers and executives, employees, shareholders, labor unions. And who are the external stakeholders? The public and local communities, media, and even the government, policymakers, and tax offices, of course. Effective corporate social responsibility requires understanding and addressing the interests of both internal and external stakeholders. By doing so, companies can build positive relationships, enhance their reputation, and contribute to sustainable development. The question arises, what factors do influence CSR? Several factors have heightened the emphasis on corporate social responsibilities, such as globalization. We all know that globalization has expanded cross-border trade and multinational enterprises, raising concerns about human resource management, environmental protection, and health and safety. Then government and intergovernmental bodies. Organizations such as the United Nations and the Organization for Economic Cooperation and Development, or OECD, have developed compacts, declarations, guidelines, and principles outlining social norms for acceptable conduct. Advances in information and communication technology. Advancement In case of technological domain, for example, the internet and the mobile devices have made it easier to track corporate activities and disseminate information, enabling non-government organizations to draw attention to problematic business practices. Consumers and investors. These groups are increasingly interested in supporting responsible business practices and demand more information on how companies address social and environmental issues. Numerous serious allegations and elevated public mistrust of corporations have heightened the need for improved corporate governance, transparency, accountability, and ethical standards. Citizens in many countries are making it clear that corporations should meet standards of social and environmental care, regardless of where they operate. There is increasing awareness of limitations of traditional approaches to corporate responsibility, prompting a re-evaluation of how CSR addresses contemporary issues. These factors collectively contribute to the growing importance of CSR in modern business practices. We all have heard about a term called triple bottom line. Now, what does it actually mean? The triple bottom line approach, introduced by John Elkington in 1997, broadens the scope of business performance evaluation beyond the financial profit to include social and environmental dimensions. This framework encourages companies to assess their impacts on three key areas: the people, the planet, and the profit. So the people can also be considered as the social capital. And this dimension evaluates the company's fair and beneficial practices towards labor, the community, and the region in which it operates. Planet or natural capital assesses the sustainable environmental practices aiming to benefit the natural environment or, at the very least, do no harm. And finally, the profit or the economic capital. It considers the lasting economic impact the organization has on its economic environment, focusing on long-term profitability and value creation. By integrating these three aspects, businesses can provide a more comprehensive understanding of their overall performance and impact on the society and the environment. The concept of triple bottom line or TBL is necessary due to several interconnected factors. Consumers are now more sensitive to a company's social and environmental actions, and shareholders are demanding greater transparency. This is coupled with stricter environmental regulations and rising legal costs for non-compliance. Other contributing factors include a general increase in social awareness, concerns over global warming, and greater media attention on social issues. Ultimately, we can conclude that the TBL is based on three core principles. A company can't survive by only focusing on profit and ignoring the well-being of the society and the environment. B, a company can't be sustainable if it prioritizes people but fails to make a profit. And C, a company cannot focus solely on protecting the environment and neglect its social and economic responsibilities. Now let us look at the difference between philanthropy and CSR. Now, philanthropy and CSR or corporate social responsibility differ in their approach and impact. Philanthropy is a form of charity involving the selfless donation of resources like money or time to address immediate needs, often in a one-off or short-term manner. It is driven by a desire to promote human welfare and provides temporary relief, but it does not typically create long-term value for a community. Conversely, CSR is a more strategic and integrated business approach. It involves a company aligning its core values with the social causes and collaborating with all its stakeholders, including employees, investors, and suppliers. CSR investments are intended to create long-term sustainable benefits for both society and the business itself. These initiatives cover a broad range of issues, such as promoting education, ensuring environmental sustainability, and improving public health. Unlike pure philanthropy, CSR isn't a selfless act. Companies derive long-term benefits from these initiatives, such as improved reputation and increased customer loyalty, which is why it's considered enlightened self-interest. Concept of corporate sustainability. Corporate sustainability is based on the idea that a company's survival and success are linked to the natural environment. It involves creating conditions where humans and nature can coexist productively, allowing for the social and economic needs of both present and future generations to be met. It ensures that businesses have the resources they need while protecting human health and the environment. Now let us look at sustainable development. Sustainable development is a broader concept that balances economic growth with environmental protection and social equity. Its widely accepted definition is meeting the needs of present generation without impairing the ability of the future generations to meet theirs. It's a process where investments, technology, and institutional changes are in harmony to meet current and future human needs. For example, using non-renewable resources like coal and petroleum wisely ensures future generations also have access to them. Sustainable development helps corporate sustainability by highlighting key areas to focus on environmental, social, and economic performance, and providing a shared goal for companies, governments, and society. So what are the 4 principles of sustainable development? Let us look into them. Number 1, principle of intergenerational equity. So preserving natural resources for future generations. Then number 2, principle of sustainable use. So using natural resources prudently to have a minimal impact on nature. Number 3, principle of equitable use or intergenerational equity. A country's use of natural resources must consider its impact on other countries. And finally, number 4, principles of integration. That is, integrating environmental considerations into socio-economic activities to ensure the wise use of natural resources. Now, what are the concepts of corporate sustainability? Corporate sustainability is a business philosophy that moves beyond the traditional model of just maximizing profit. It focuses on a company's simultaneous growth and profitability while also prioritizing environmental protection, social justice, and economic development. This approach builds long-term shareholders' value by actively managing the risks and opportunities that arise from social and environmental issues. It involves business practices that consider the needs for stakeholders today while protecting and enhancing the human and natural resources needed for the future. The 3 core elements of corporate sustainability are the economic sustainability, the social sustainability, and the environmental sustainability. The economic sustainability ensures the company is financially viable and provides goods return to investors, while the social sustainability is all about creating a supporting environment for employees and meeting the expectations of external stakeholders. Environmental sustainability, on the contrary, actively works to eliminate negative impacts on the natural environment and contributes to the health of the biosphere. To achieve this, companies must focus on internal capacity building, assessing their social impact, and repositioning themselves through innovation and development. This long-term approach allows a company to operate sustainably while creating lasting shareholders' value. Now let us look at corporate sustainability and corporate social responsibility. Now, corporate sustainability focuses on a firm's long-term value creation by integrating economic, environmental, and social considerations into business operations to achieve a sustainable competitive advantage. Corporate social responsibility, or CSR, on the contrary, is rooted in the broader idea of businesses' obligations to society, including satisfying legal, ethical, and community-based norms and expectations beyond just maximizing profits for shareholders. Now let us look into the key differences and similarities. Corporate sustainability is an adaptation of concept of sustainable development to the corporate environment. It is defined as a business approach that creates long-term shareholders' value by managing risks and opportunities from economic, environmental, and social factors. This approach often involves the concrete challenges of measuring performance across the three dimensions, which are processes, products, and procedures. Corporate social responsibility, on the other hand, is a concept with a different historical and theoretical background. The text which you have in your hand traces its origins to the idea of business having obligations to society beyond just making a profit and obeying the law. A significant development in the CSR approach was the rise of the stakeholder theory, which expanded a company's obligations to a wider group of stakeholders, anyone affected by or who can affect the firm's objectives, not just the shareholders. It is important to note here that the CSR involves conforming to social norms and making voluntary contributions to the community. Now let us look at the convergence of these terms. Despite their different origins and paths, the two concepts have converged. Recent definitions of CSR, such as one from the Prince of Wales International Business Leaders Forum, now include a focus on creating sustainable value to society at large, which blends the goals of both concepts. Both CS, or corporate sustainability, and CSR, or corporate social responsibility, are crucial for businesses to effectively address the challenges of sustainability. Now let us discuss about the reputation risk of Board of Directors, or BODs. According to the context which we have already discussed in our earlier and in our continuing discussions related to corporate governance, the Board of Directors play a crucial role in protecting and improving a company's reputation. Reputation is a valuable intangible asset that helps a business to attract resources and maintain a competitive advantage. A major threat to a company's reputation is the failure to meet shareholders and the stakeholders' expectations regarding sustainability, specifically economic, social, and environmental performance. The role of sustainability. The role of sustainability is all about embracing sustainability is a strategic move for a board of directors to mitigate reputation risk. So, by focusing on sustainability, a company can achieve several benefits. Enhancing reputation. It helps build brand value, increase consumer loyalty, and boost employee morale and retention. Mitigating risks. It helps in identifying and managing risks within a company's own operations as well as with its suppliers and clients. Improving efficiency. It can lead to reduced waste of energy and raw materials, driving growth. It helps open up new markets for a company's products and services. In short, a strong focus on sustainability provides a strategic, long-term competitive advantage by protecting and enhancing a company's reputation. Now let us look into the vested interest of stakeholders in sustainability. All stakeholders have vested interest in a company's sustainability. This is because a company's long-term health and ability to continue operating directly impact various groups beyond just its shareholders. Stakeholder interests in corporate sustainability. The first group that we are going to discuss is the shareholders. Shareholders want to maximize their financial returns both from dividends and by selling their securities at a profit, which is capital gain. The second group, employees. Employees rely on the company for their livelihood and to secure benefits like retirement funds. Then comes creditors and suppliers, who depend on the company's continued operation to ensure they are paid back on their loans and that their business relationships continue. Then comes customers, who want to keep doing business with the companies that provide quality products and services, and they need the company to remain viable to honor warranties and guarantees. Then comes the community. The community benefits from the job and wealth that corporations create, as long as the companies practice good governance and are environmentally responsible. The environment itself. The environment depends on companies that operate sustainably and are environmentally friendly. Then comes the government. Governments of different countries rely on corporations for a significant portion of their income through taxes, which is then reinvested into public infrastructure, health, and education for the citizens. Reporting to stakeholders on sustainability. While discussing this, the first thing that we are going to encounter is sustainability reporting. Now the question is, what is it? What is sustainability reporting? Sustainability reporting is the process of publicly disclosing an organization's performance on economic, environmental, and social issues. It goes beyond the traditional financial reports to provide a comprehensive view of a company's impact and its commitment to a sustainable global economy. There are two types of benefits of sustainable or sustainability reporting. The sustainability reporting offers internal benefits and external benefits. Internal benefits include the understanding of risks and opportunities, links to financial and non-financial performances, streamlining processes to improve efficiency, and benchmark performance against industry standards. Now, what is the external benefit? Sustainability reporting improves a company's reputation and brand loyalty, allows external stakeholders to understand its true value, and demonstrates its influence on and being influenced by sustainable development expectations. Now, what are the key drivers? There are several key drivers driving the increasing adoption of sustainability reporting. The first one is regulations. Governments are shifting from voluntary to mandatory reporting. Then customers, consumer preferences, and public opinion are powerful forces that influence companies. NGOs and the media. These groups shape public opinion and damage brand value if a company's sustainability practices are poor. Employees. Now, as concerned citizens, employees are pressuring their employers to act responsibly. Peer pressure. Companies are influenced by industry standards and often request sustainability information from their partners in the supply chain. Companies themselves. Organizations recognize that sound social and environmental policies are critical for long-term success. And finally, the investors. A growing number of investors want to see that companies have responsible long-term business approaches. Now let us discuss about the challenges of sustainability reporting. Despite its benefits, to be precise, sustainability reporting faces several challenges. The first one is government encouragement. Many jurisdictions lack guidelines to encourage corporate sustainability reporting. Then awareness. There is a general lack of awareness among professionals, board of directors or BODs, and management about the importance of sustainability reporting. Then expertise. It's a relatively new concept, so there is a shortage of professionals with the expert knowledge needed to prepare these reports. And finally, investors' behavior. While there are guidelines for institutional investors to consider environmental, social, and governance or ESG issues, not all investors consistently do so. Now let us discuss about the Global Reporting Initiative or GRI. The Global Reporting Initiative or GRI is a globally accepted framework for non-financial reporting or sustainability reporting. The framework provides guidelines for companies of any size, sector, or location to disclose their economic, environmental, and social performance. The GRI reporting framework aims to help organizations and their stakeholders understand a company's contribution to sustainable development. It includes sustainability reporting guidelines, which is the core of the framework, which outlines content relevant to all organizations. In 2013, the GRI G4 guidelines were introduced to help companies create reports with valuable information on their most critical sustainability concerns. The sector supplements specific guidance for different industries. Indicator protocols, detailed instructions on how to measure and report on specific indicators. The guidelines consist of two parts. The first part is the reporting principles and the standard disclosure, and the second one is the implementation manual. The reporting principles and standard disclosure contains the fundamental principles for preparing a report and the required disclosures. The implementation manual provides practical guidance on how to create the report. Principles and disclosures. The GRI framework is built on key principles to ensure transparency. Content principles. It guides organizations on how to decide what content to include in the report by considering the organization's activities, impacts, and the interests of its stakeholders. Quality principle. It ensures that the reported information is accurate and well presented, allowing stakeholders to make sound assessments. The framework requires two types of standard disclosures. Number one, general standard disclosure and specific standard disclosure. General standard disclosure includes information on a company's strategy, organizational profile, governance, ethics, and stakeholder engagement. Specific standard disclosures, on the other hand, includes details on a company's economic, environmental, and social impacts. These include topics like labor practices, human rights, and product responsibility. The GRI framework focuses on material aspects only. That means those that have significant economic, environmental, or social impacts, or that substantially influence stakeholder decisions. Now let us discuss about the integrated reporting. Integrated reporting is a new approach to corporate reporting that goes beyond traditional financial reporting. It provides a concise, holistic view of an organization's performance by connecting its strategy, governance, and prospects to its ability to create value over the short, medium, and long term. Key concepts include integrated thinking. That is the foundation of integrated reporting. Integrated thinking helps an organization understand how different factors, such as financial performance, social reputation, and human capital, are interconnected and contribute to value creation. Then the second one is the value creation. Integrated reporting is built on the concept that a company's value is shaped not just by financial performances, rather by its use of various resources and its impact on society. Purpose. The primary goal is to explain to the providers of the financial capital, that is the investors, regarding how an organization creates value over time. However, it also benefits all stakeholders by providing a more complete picture of the company. Now let us find the distinctions between integrated reporting and sustainability reporting. Integrated reporting is considered a step beyond sustainability reporting. While sustainability reporting focuses on a company's economic, environmental, and social performance in separate document, integrated reporting combines this information with financial data into a single cohesive report. Sustainability reporting is seen as a fundamental element of integrated reporting, providing the necessary input for a company to identify its material issues and assess its ability to create value. Guiding principles. The International Integrated Reporting Council, or IIRC, has developed a framework with guiding principles to ensure the quality and consistency of integrated reports. These principles include strategic focus, that is, the reports should explain how strategy contributes to value creation. Connectivity. The report should show the relationship between different factors that affect value creation. Stakeholder relationships. Report should provide insights into how company interacts with its stakeholders. Materiality. The report should focus on information that significantly affects the company's ability to create value. Conciseness. The report should be easy to read without being burdened by less relevant information. Reliability and completeness. The report should be balanced and free from errors. Consistency and comparability. The information should be presented consistently over time and allow for comparison with other organizations. Thank you.